So imagine making $1.5 billion in a single summer.
Yeah, which is a massive amount of money.
Right. You're breaking your company's all-time historical sales record. You're seeing the highest weekly revenue you have literally ever seen. And then, you have to call your investors to tell them you actually lost $57 million.
It is the kind of financial paradox that makes you immediately want to audit the books.
Totally.
Because on the surface, those two realities, they just simply shouldn't be able to coexist in the exact same quarter.
Yeah. And if you're sitting there wondering how a company can pull in $1.5 billion and, still end up in the red, you aren't alone.
So today, we are doing a deep dive into Aeromexico's unaudited Q2 2026 earnings report. It came out on July 13th, 2026.
Right.
But the goal here isn't to just rattle off numbers from a spreadsheet. We're looking at this document because it is essentially a masterclass in the incredible, this high-wire economic balancing act of running a modern global airline.
Yeah, absolutely. We want to decode how extreme macroeconomic shifts actually hit the ground.
And what's fascinating here is that the $57 million loss wasn't the result of a singular catastrophic management failure.
Right.
It was really the result of a perfect storm. You have global geopolitical events that radically altered the baseline cost of running a transportation network.
Which is huge.
Yeah, and then you have extreme rapid currency fluctuations. And on top of all that, you have this temporary, totally bizarre behavioral phenomenon in June.
The World Cup?
Exactly.
Yeah.
Specifically, the World Cup.
So, to understand the massive costs that dragged them down, we first need to understand where that record-breaking $1.5 billion top line actually came from. Total revenue jumped 12.6% year over year.
That's a huge jump for a legacy carrier.
It really is.
Okay.
And to really grasp that, we need to look at a core metric in the airline industry, which is TIR-ESM.
Yes, TIR-ESM.
Right, total revenue per available seat mile.
Which is arguably the most important pulse check for an airline, When you fly a plane, a seat is basically this highly perishable piece of real estate.
Like trying to sit at a grocery store.
Exactly. The moment those cabin doors close, any empty seat just loses its value entirely. You can't sell it tomorrow. So TIR-ESM measures exactly how much revenue the airline generates for flying one seat for 1 mile, regardless of whether a human being is actually sitting in it or not.
Got it.
It blends your ticket prices, your baggage fees, and your occupancy rates into just one clean number.
And Aeromexico's TIR-ESM hit 16.0 cents, which is a 10.5% increase from the previous year.
Right.
That is a very substantial leap.
Mm-hmm.
And the report notes it was driven heavily by international passenger revenue. But reading further down the page, there's this data point that totally recontextualizes that revenue jump.
Mm-hmm.
Their total passenger volume actually dropped.
Yeah. They flew 2.7% fewer people. It was about 6.01 million passengers total for the quarter.
Wait, so they flew fewer people, but they made significantly more money per available seat. And the engine behind that efficiency is what they call their premium revenue mix. The report says it hit an all-time high of 43% of their passenger-related revenue.
Right. And to put that into perspective, almost half of the money they make from flying people is coming from a fraction of the seats on the plane.
Wow. Half the money from a fraction of the seats?
Yeah. The business model for global legacy carriers has heavily shifted toward capturing these high-yield customers. These are the passengers paying for, business class, premium economy, lounge access.
Flexible ticketing, all that stuff.
Exactly. When your premium mix reaches 43%, you are fundamentally insulated against certain types of volume drops.
Which perfectly brings us back to that strange June phenomena you mentioned earlier, the World Cup.
Right. World Cup blip.
The data shows demand temporarily moderated in June simply because people were staying put. They didn't want to be on a 5-hour flight while their home country was playing in the knockout rounds.
Nobody wants to miss those games.
No. So here's where it gets really interesting. It's like throwing a massive club night where the VIP section is completely sold out at premium prices, right? But suddenly, everyone leaves the general admission dance floor for a month just to go watch a soccer game on the TVs in the lobby.
That is exactly it. And the club still breaks its revenue record.
Yeah.
Aeromexico's internal numbers show that maintaining that 43% premium mix during a temporary demand shift like the World Cup is what saved their top line.
So they didn't just slash economy prices to fill seats?
No, they didn't need to heavily discount the economy cabin to pack the plane to the brim because the front of the aircraft was generating so much disproportionate value. That high-yield demographic completely offset the 2.7% drop in raw overall passenger volume.
Okay, so if the front of the plane is essentially printing money, and the top-line revenue is higher than it has ever been in the history of the company,
Yeah.
what burned a $57 million hole in the balance sheet?
Well, we have to look at the fuel pump.
Yeah, it was an exceptionally expensive quarter to fill up a jet. The numbers here are just staggering. Their total fuel expense was $493.8 million.
Wow.
That is a 79.9% year-over-year increase, basically an 80% jump in their single largest operating cost. The report states that fuel cost averaged $4.20 per gallon in Q2 2026.
Then in Q2 of
It
2025.
was just $2.34.
Right. So the jump from $2.34 to $4.20, I mean, that changes the entire calculus of route profitability. And it's really important to note that airlines usually try to protect themselves from this, right?
With hedging.
Yeah, exactly. They use financial instruments to hedge fuel prices, locking in rates months in advance to ensure predictability. But the global geopolitical events that started in late February created this market shock that blew right past a lot of those protections.
But prices just stayed high.
Market prices stayed elevated straight through the quarter. In fact, the report explicitly states this geopolitical shock cost the airline $30 million more than their own internal forecasting models had predicted.
$30 million over their own worst-case guidance? That level of external volatility is just wild. But looking closely at the operational data, the airline was really doing everything physically possible to mitigate it.
What were they doing on the operations side?
Well, their actual fuel consumption was completely stable year over year, despite flying slightly more capacity. And their fuel burn per available seat mile actually dropped by 1.7%.
Oh, that makes sense. That 1.7% drop is the direct payoff of heavy capital investment.
You mean the new planes?
Yeah. Over the last few years, they've been aggressive about modernizing. They have a younger, highly efficient fleet now. The average age of their 169 aircraft is just 8.9 years old.
That's pretty young for an airline that size.
Very young. And it's primarily because they've been adding new Boeing 737 MX-8s for their short-haul stuff and the 787-9 Dreamliners for international routes. So the actual metal tubes they're flying are doing a lot more work with a lot less kerosene.
But, I mean, the efficiency of the planes only goes so far when the fuel itself is that expensive. And this is where I want to push back on the core narrative of the report a bit.
Okay, let's hear it.
If your main operating cost essentially doubles overnight due to global politics, how is this not a total financial catastrophe for the company? Like, taking a $57 million net loss is bad, obviously, but mathematically, an 80% spike in fuel should have wiped them out entirely. Why did they only lose $57 million?
Yeah, that is the crucial question to ask when reading any transportation earnings report during a commodity spike, and the answer lies in a mechanism called recapture.
Okay, so how does recapture actually work in practice?
Well, when a massive external cost hits, an airline basically has two choices. They can eat the cost and just watch their margins completely vanish, or they can try to pass that cost on to the consumer to recapture the lost margin. According to the data here, because of their disciplined pricing strategies and the strength of that 43% premium mix we talked about, Aeromexico actually recaptured about 75% of that incremental fuel cost.
Okay, let's do the actual math on that from the report because it's wild. Their fuel expense went up by about $219 million compared to the previous year.
Right.
But their total revenue went up by $165 million. So that revenue growth absorbed 3/4 of the raw fuel shock.
And the mechanism for how they achieve that recapture is fascinating. It comes down to really strict capacity management.
Meaning how many flights they actually schedule.
Exactly. When fuel is $4 a gallon, the absolute worst thing an airline can do is add new marginal flights that are only half full or, flood the market with cheap promotional tickets just to maintain their market share.
Because flying an empty seat at $4 a gallon is just burning cash.
Exactly. Every cheap ticket sold on an expensive flight is a net negative. So what they did was they artificially constrained the supply. They only increased their available seat miles by a tiny margin, just 1.9%.
So they kept the supply of seats incredibly tight. And when supply is tight and demand from premium travelers is still high, the airline's dynamic pricing algorithms just automatically push ticket prices up.
Yeah, the consumer ends up paying for the expensive fuel without explicitly seeing a fuel surcharge on their receipt.
They just think, wow, flights are expensive this summer.
Right. They completely aligned their supply of seats with the reality of an incredibly expensive market. They protected their pricing power and just let the algorithms do the heavy lifting to pass those costs along.
So they survived the fuel shock by constraining supply. But looking deeper at the balance sheet, there was an entirely different crisis brewing internally.
Yeah, the currency issue.
Exactly. While global oil markets were hammering them from the outside, the Mexican currency was creating a massive squeeze on the inside.
Right, because running an international airline means you aren't just managing aircraft and crew, you are actively managing a massive foreign exchange portfolio.
Which sounds so complicated.
It is. The macroeconomic forces impacting the currency can be just as volatile as the price of oil.
And during the second quarter, the Mexican peso appreciated 11.3% against the U.S. dollar. It averaged 17.4 euro pesos per dollar, down from 19.61 the year prior. Now, Aeromexico's reporting currencies, like the way they present their financials to the world, is the U.S. dollar. So when the peso gets stronger, any tickets sold in Mexico convert into more U.S. dollars. That currency strength actually provided an artificial lift to those record-breaking revenue figures we talked about earlier.
Yeah, a strong local currency makes the top line look absolutely fantastic when it's converted back for the earnings report.
But there's a catch.
There's a massive catch. There's a secondary effect that hits the operation side really hard.
Yeah, it's a total double-edged sword. Having a strong local currency, it's like having this powerful tailwind that is simultaneously blowing you slightly off your flight course.
That's a great way to put it.
Right. Because yes, your revenue looks great in dollars, but suddenly paying all your local staff, your ground operations, your local vendors, that all becomes significantly more expensive on paper.
And we see that squeeze perfectly reflected in a metric called ASMX. That stands for Cost Per Available Seat Mile, excluding fuel.
Wait, why do airlines exclude fuel from that specific metric?
Because airline management cannot control the global price of oil, right? Or geopolitical wars.
Here.
Investors use ASMX to judge how well the executive team is managing the costs they actually have control over, things like labor, maintenance, marketing, and airport fees. By stripping out those volatile fuel costs, you get a much clearer picture of the underlying operational efficiency.
And Aeromexico's ASMX rose 12.3% to 10.0 cents. That is a massive jump for costs that are theoretically under management's control.
It is, but the context here is that the jump was primarily driven by that strong peso. Let's look at labor, for instance.
Okay.
If you have a mechanic or a pilot whose contract includes inflation-related salary adjustments and you're paying them in pesos, your real costs are going up. When you then convert those higher peso salaries into a U.S. dollar reporting currency, and remember, the peso is 11% stronger than it was last year, your labor line item on the balance sheet just skyrockets.
So they were basically fighting a brutal war on two fronts. The geopolitical fuel prices were hammering them, forcing them to hike ticket prices, while the strong peso was artificially inflating their local operating costs, which drove up CSMX.
And on top of that, they were also dealing with higher depreciation costs.
Oh, from the new planes.
Exactly. Remember that young, fuel-efficient fleet we just talked about? Buying all those new Boeing planes in 2024 and 2025 means you have significantly higher depreciation expenses hitting the books in 2026. So when you combine the currency squeeze, the inflation-adjusted labor, and the fleet depreciation, you get a massive hike in operational expenses that is completely separate from the fuel crisis.
Man, what a quarter. But here's the piece of the report that really stopped me in my tracks.
What's that?
After fighting this two-front war, absorbing an 80% fuel spike, dealing with currency inflation, and reporting a net loss of $57 million, their actual liquidity position is incredibly robust.
Yeah, it's very healthy.
They ended the quarter with $1.0 billion in cash and cash equivalents, and a total liquidity of $1.2 billion.
That $1.2 billion in liquidity represents almost 20% of their last 12-month revenues. It is a massive cushion to fall back on.
But how do you report a net loss but still hold on to $1 billion in cash?
That's the magic of accounting. Because a net loss on an income statement includes non-cash expenses, like that heavy aircraft depreciation we just mentioned. It's an expense on paper, but cash isn't actually leaving the bank account to score for it.
Oh, okay.
If you look at their actual cash flow, the business of flying planes is still generating tremendous capital. I mean, they generated $362.4 million in net cash from operating activities during the first half of the year alone.
Wow.
The core engine of the airline is producing cash, which allowed them to even pay down some financial debt during this totally turbulent quarter.
Which brings us to their flight path looking forward. Given everything they just navigated, I fully expected management to issue a very cautious, conservative forecast for the second half of 2026.
Most people did.
But instead, they are painting this surprisingly aggressive picture. They're predicting an improving macroeconomic backdrop and sustained healthy demand.
And crucially, they are expecting major relief at the fuel pump. Their forward guidance forecasts average fuel cost dropping to $3.20 per gallon in Q3 and down to $3 flat by Q4.
So they expect fuel to drop $1.20 a gallon by winter. But there is a specific financial projection for the fourth quarter that I really need to unpack with you because it sounds almost too good to be true.
The margin expansion.
Yes, they are forecasting their adjusted EBITDA margins to expand massively, hitting between 28 and 31%. But before we get into whether that is realistic, hold on. For those of us who don't read financial statements for a living, what exactly does adjusted EBITDA actually measure?
Yeah, it is quite a mouthful of an acronym. It stands for earnings before interest, taxes, depreciation, amortization, and rent, or, restructuring costs.
Right.
In the airline industry, it's essentially the purest way to measure the cash-generating ability of the actual day-to-day flying operations. By excluding depreciation and aircraft rent, it strips out the long-term capital decisions about how the company finances its planes.
So it just isolates the operations.
Exactly. It just looks at whether the core business of selling tickets and flying routes is actually profitable.
Okay, so it isolates the pure operating engine,
Mm-hmm.
but projecting a 30% margin on that engine by Q4, right after the brutal quarter they just had, I mean, that feels like a massive leap. Are they just projecting optimism to keep investors happy, or is there a tangible mechanical reason they expect to become that profitable that quickly?
Oh, there is a very tangible mathematical reason for it. And it comes down to this fundamental principle of industrial economics, operating leverage.
Okay, let's walk through how that works in this context. To me, operating leverage is like running a factory, right?
Mhm.
If you already pay the rent, the insurance, and the administrative salaries to run the factory for an 8-hour day shift, adding a night shift doesn't double your costs.
Yeah, not at all.
You just pay for the extra labor and the materials. Because the fixed costs are already covered by the day shift, the profit margins on everything produced during that night shift are substantially higher.
That factory analogy maps perfectly onto how Aeromexico plans to hit those Q4 margins. To achieve that growth, their forecast states they plan to increase their capacity by 6.5 to 8.0%. But they are not going out and taking on billions in new debt to buy more planes to fly those new routes.
They're just going to increase the utilization of the 169 aircraft they already have. They're just adding the night shifts.
Precisely. They are going to fly the existing fleet more frequently. The fixed costs for an aircraft, like the monthly lease payment, the base salaries for the crew, the headquarters overhead, those are exactly the same whether that plane flies 2 routes a day or 3 routes a day.
So if they add a third daily flight from Mexico City to New York using a plane that is already paid for,
The only new costs are the direct variable costs. So the fuel for that specific flight, the landing fees, and the hourly wages for the crew.
wow.
Once the fixed costs of the aircraft are covered by the first 2 fleets, every ticket sold on that third flight is incredibly high margin revenue. That is operating leverage in action.
So if fuel prices behave and drop to that $3 mark like management predicts, the efficiency of flying those existing planes more frequently translates directly into massive margin expansion.
It's a brilliant strategy, and it really highlights why you can never just look at a headline net loss and assume the business is failing. You have to look at the mechanics underneath the hood.
The mechanics of Aeromexico's operation are highly tuned. They manage to protect their cash flow and position themselves for significant operating leverage, all while absorbing macroeconomic shocks that would have probably grounded a less disciplined airline.
Yeah, absolutely.
And that is exactly why we wanted to dig into this specific report today. Aeromexico's Q2 2026 performance isn't just a story about one airline. It is a real-time study in corporate resilience. It demonstrates exactly what happens when an immovable object, like an 80% spike in global fuel costs, collides with an unstoppable force, which is the record consumer demand for premium travel.
It's really a lesson in the power of dynamic pricing. The core takeaway here is discovering just how much of a macroeconomic shock a company can realistically pass onto the consumer before demand breaks.
Right. And the data shows they passed on 75% of it. They absorbed a quarter of the shock. The algorithms pushed 3/4 of the cost onto the consumer, and the premium VIP customers didn't even blink. They just paid the higher fares.
They just paid it.
Which leaves me with a thought I really want you to mull over after listening to this deep dive. As we watch global airlines get better and better at managing massive, sudden crises, passing global fuel spikes seamlessly onto consumers through algorithmic pricing, and relying so heavily on a booming 43% premium customer base to stay afloat, what happens to the rest of the plane?
That's the real question.
Will standard economy travel eventually become totally decoupled from an airline's actual profitability? Are we heading toward a future where regular passengers bear the brunt of algorithmic price hikes during global crises, while airlines cater exclusively to the front of the plane just to survive?
It's a fascinating thing to consider.
It's a shifting dynamic that goes far beyond a single earnings report, and it will dictate the future of how we all travel. Thank you for joining us for this deep dive into the numbers behind the headlines. Keep questioning the data, keep looking for the mechanics driving the story, and we will catch you next time.